We have a critically important update for all Tesla stock investors, or really anyone invested in our markets at all. Because in this video, we are going to get into the retail sales data coming out tomorrow and how this could move our markets, whether it comes in really good or really bad. There's big possible implications in what that could mean for the next couple of weeks for stocks. But I think even more important than that, the bulls are going to love this one. Quantitative tightening seems to be coming to an end very soon. This could be a $90 billion stimulus to our markets every single month. This will begin to have a positive impact on equities. So that is the tip of the iceberg of what will be discussed here in this video. Let's go ahead and jump into it. But first, let's cover specific Tesla stock news coming out this evening. It appears that Uber steps up efforts to get drivers into Teslas. Uber has begun sharing data with Tesla about where its drivers do most of their trips, starting in New York City. That will help demonstrate where charging infrastructure is most needed. It's also offering drivers incentives of up to $2,000 on the purchase of a Tesla Model 3 or Model Y, and is hosting test drive events at select Tesla stores to expose drivers to the EV experience. It appears that Uber is trying to cozy up to Tesla. After all, if Tesla does create a robo-taxi service, that's a risk for Uber. So you could see a possible partnership coming down the line between the two companies. Definitely something worth mentioning. Ross Gerber seems to be emotional yet again tonight. What's new? He says, quote, "Right now, Tesla's a mature company looking at a lot of challenges in front of them with an unfocused CEO." Just for the record, I think that's false. I think Elon is very focused on Tesla, clearly. But let's be honest. Let's take away Ross Gerber's paycheck and see how focused he is on making his clients money and not cutting himself a check. Adrian Dipman on X says it took Boston Dynamics 30 years to achieve what Tesla achieved in one. Elon said 2 years to meet, 3 years to beat. No acquisitions, and Optimus is a startup. Here you can see this 16-second clip of Optimus and the improvement you have seen in just 1 year's time from January of 2023 until January of 2024. I mean, there's no comparison, right? January of 2023, the robot could stand, move its hands, and barely walk without falling over. Look at the thing today. I mean, it's folding a shirt. Pretty soon here, it's going to be able to be sold to companies that can do simple tasks like warehouse jobs or manufacturing jobs that still lack enough employees. Elon also says that the Model 2 will blow people's minds. Tesla stock is up 1/3% here in extended trading because of this news. Andrea S. James on X says, no, he didn't say that he was out, despite the media attempts to misconstrue. Public promoted this article. It's not exactly Public's fault. They just promote articles from time to time. But it's an article from Business Insider that says Elon Musk puts the brakes on AI development at Tesla until he gets more control, saying with a definitive that is happening. Elon Musk just responded and says, never believe anything written by Business Insider. That fake publication is not worth reading at all. Utter trash. And it does indeed seem like Tesla stock is reacting to this news, as some people may be more inclined now to believe Elon is going to walk away from Tesla if he does not get a comp package, and we just don't know when that could happen. It's getting held up in the Delaware courts as we speak. But it looks like, indeed, Elon is not slowing down AI or robotics over at Tesla. After all, that makes sense because just yesterday we seen Optimus and a new video published that it can now fold a shirt. And what I found most exciting about that video was how Optimus here, look right here, the robot, before it starts folding the shirt, realizes it's half off the table and pulls it back on the way on the table. That's pretty smart technology and a lot of improvement in just the past year. Final option activity for Tesla here on the day today from hedge funds and institutions comes in at $1.7 billion, so on the higher end, with a positive order value of 64%, which is very good. But as exciting as all of this Tesla stock news is, let's get into this stimulus situation that could be unfolding over the next couple of weeks. Check out this article from Zero Hedge. Quote, "It's all over. Powell's Wall Street Journal mouthpiece and JP Morgan confirm imminent end of QT." Now in 30 seconds, let's explain what quantitative tightening is and quantitative easing. Quantitative easing started around 2008 when there was a large supply of treasuries, not enough capital to buy them. That's when the Federal Reserve swooped in to buy the treasuries and keep rates lower for longer. This has grown the Fed's balance sheet from about $880 billion during the Great Financial Crisis to about $9 trillion back in early 2022. They have since ran down their balance sheet to about $7.7 billion, so that $2+ billion has been absorbed back into the marketplace, giving us higher yields on bonds. In simple terms, when the Fed starts quantitative easing, they start buying bonds back again, and that will push rates lower. But this $90 billion a month potential stimulus to our markets is because the Fed is currently running off their balance sheet $90 billion a month for almost 2 years now. So that means banks had to soak up all of the extra treasuries on the markets. Thus, when there's not a guaranteed buyer, yields on bonds tend to move up. And that's partly why treasuries hit over 5% towards the end of 2023. Well, as you can see here on screen, the overnight reverse repurchase agreement market is basically, long story short, where the banks keep their excess cash because they don't want to keep it all on their balance sheet because there's risk associated with that. So they park it with the Fed and buy short-term treasuries. Well, this has rapidly been falling. Back on July 21st, for an example, of 2023, there was about 1.8 trillion of excess reserves in the banks. That banks were buying these overnight repurchase agreements. They come with a very low interest rate. It's basically somewhere just for the banks to park their money. Now, as of today, you have worked that down to $583 billion. So it is mathematically impossible for the Fed to not reduce the pace of their balance sheet runoff. Because if the banks run out of excess capital, then you get put in a situation where treasuries could just run rampant. 5%, that could just be the start. We're talking 10% or more. You could break the bond market if you don't slow down or stop the pace of the balance sheet runoff. Think about it like this. The government has been raising a ton of money, $1 trillion plus in the last 6 months. Well, who do you think buys that? Mainly the banks, government, so on and so forth. But you have that plus the Fed selling treasuries off their balance sheet or letting them run off their balance sheet. So it's even more supply than what we otherwise would have seen. Supply that was really in the marketplace years ago that is coming back. And you know that 6.2 trillion in money market funds that I believe will head back into our markets in the second half of 2024, maybe Q2 of 2024, this process could start. Well, if the Fed is no longer doing quantitative tightening, that could happen at a much more rapid pace. Real-time economics on X today says Fed deliberations on slowing the shrinking of its holdings will start as soon as this month's policy meeting and aim to avoid disrupting financial markets. JP Morgan also wrote, quote, "We now expect the FOMC will have the outline of a timeline at the January meeting communicated mid-February minutes to the meeting. We expect that this plan will be formally agreed to at the mid-March meeting and will be implemented beginning in April." JP Morgan expects the monthly cap on the runoff of Treasury securities to be reduced to $30 billion a month, down from $60 billion a month currently, but this could actually go much lower than that. I would think maybe $10 billion or so a month. That would allow the Fed to potentially do quantitative tightening in a very small form for a long time, but that would be a 5x reduction of what we are currently seeing now. Fed Waller also said today it is reasonable to consider slowing the asset runoff this year. Dallas Fed President Lori Logan also says the Fed should pretty soon stop rolling off 60 billion every single month and draw that down to a number that is sustainable for a long period of time. Again, that could be 5 billion, that could be 10 billion. Who really knows the exact number, but it will be a lot smaller than 60 billion, just given how fast the balance sheet has been reduced in just a short amount of time. 1.8 trillion was the balance sheet in July of 2023. Now you're at less than 600 billion. That's a huge reduction in a short amount of time. Cash is running out of the system, and that's a big risk. Now, that would be a big benefit to Tesla stock, specifically to your interest rate sensitive names, because if the Fed reduces their balance sheet runoff, that gets implied to the markets as if rates are probably not going higher from here. You're going to have a downward pressure on rates, something we have not seen in 2 years. That's going to be positive for long-term growth valuation. If theoretically this balance sheet reduction starts in April, is announced in March, this could be something in the very near term that starts to get priced into Tesla and your interest rate sensitive names and could have a short-term boost. But really, second half of 2024, if things go as I expect, we could be seeing some pretty big gains for Tesla stock. I do think in the near term, though, we have a bit of a problem. Wall Street overall is too bullish on 2024 earnings expectations. I've talked about this before, but this is a major risk over the next couple of weeks because we're going to get full year guidance outlooks from companies that report earnings. So right now, the S&P 500 is expected to grow EPS by 11%. If that does not happen, stocks are trading at higher multiples than we believe. Check this out. UBS says, quote, "We are increasing our 2024 S&P 500 target from 4850 to 5150. That would be like the SPY 485 to 515 by the end of this year. They say while earnings should drive 2023 returns, I believe they meant 2024 returns, lower rates should support incrementally higher multiples. The multiple's already high for big tech. The multiple is in line with historical averages for 490 of the other S&P 500 stocks. So I don't think the gains would be in big tech, but really a catch up in the broader markets if earnings do indeed come in line with expectations or beat, which that's going to be almost impossible to do right now. I think there's a much greater chance over the next couple of weeks. Expectations go from 11% to say 7% instead of expectations going from 11% to 15%. If that does happen though, if estimates go higher than 11%, well, stocks are going to do well, but odds are I think there's probably an 80% chance the estimate actually gets lowered, and that's short-term negative for Tesla and for the broader markets. Another short-term risk that I have mentioned before plenty of times now here on the channel is January 31st. Markets are still pricing in 6 rate cuts by the end of 2024. If we're still pricing in 6 rate cuts by January 31st and we hear from Fed Jerome Powell, it's going to be a rough day. Jerome Powell is going to hawk down on the markets and say, we're not doing 6 rate cuts. He's going to say the situation's going to be bad in the economy if we're doing 6 rate cuts. So he's going to say, I hope we don't do 6 rate cuts. Something along those lines. For the SPY, which hit a new all-time high on Friday, I mean, it's not like you're in a low depressed point for the SPY. You're pretty vulnerable here for bad news. Tesla stock, on the other hand, if you are all in on Tesla, well, it's already fallen a lot, so I think you're a little bit less vulnerable to big drops on bad news. But still, this is a risk for Tesla stock over the next couple of weeks. Goldman also writes today, quote, "We have not made any changes to our baseline forecast that the FOMC will deliver a series of 3 consecutive cuts in March, May, and June before slowing to a quarterly pace. However, we see Waller's comments today as increasing the risk that the first cut could come somewhat later or that the FOMC might prefer to cut once per quarter from the outset." So basically, we're not going to get potentially anywhere close to 7 rate cuts. That would be 4 rate cuts in 2024 if they cut once per quarter. Right now, markets are pricing a rate cut at every single Fed meeting from March through December. So again, it's not like we're heading into earnings or the Fed or really any bad news on a low note, right? Expectations are very high. The Fed's going to be accommodative. The economy is going to be just fine. And earnings are going to come in, well, great. That is why I do have some hedges on my portfolio. We do, at least in the trading community. If you guys want to come join that, come get access to all of those trades every time I make them, check out the link down below in the description of this video. Those trades are not financial advice. You are subject to lose all of your money if you don't take risk management into calculations and into your own trading. We do these trades with very small percentages of our portfolio. They're hedges. They're sometimes YOLOs. They're not expected to make money. That's important. Now, as I have mentioned previously here on the channel, we will get earnings coming Wednesday pre-market, so tomorrow pre-market. Citizens Financial, US Bancorp, Prologix, and Charles Schwab. These guys are not going to be important, but Wednesday and after hours, you will get Alcoa, Discover, and Kinder Morgan. Discover's the big one because we want to see, are consumers defaulting more? Did their credit card balances grow? What are the interest rates like? Are people signing up for new credit cards? There's a lot of data and information about the economy, about the consumer, that we will get from Discover earnings alone. So coming tomorrow, I do expect that's going to have an impact on our markets after hours tomorrow, heading into Thursday. And honestly, I don't think it's going to be a pretty report. Now to your economic calendar for tomorrow. First up, you're going to have some Fed speakers between 9 and 9:15 in the morning. Fed Bar, not going to move the markets. Fed Bowman will likely move the markets. Fed Woods, I can't recall ever hearing them speak, so I doubt that's going to move the markets too much either. But Fed Bowman definitely can move the markets. Fed Bar can move markets as well, but he typically speaks about bank regulation a lot more than he speaks about actual Fed policy. He's the bank regulator guy of the Fed, so I don't think that's going to be important. But retail sales month over month for December are expected at 0.4%. Now, this is a pretty high expectation overall. We want to see this come in as high as possible. So I would much prefer like a 2% month over month number than a negative 2% month over month number. If you get a really bad number here, expectations for Q4 GDP will fall and people will start to question how strong the economy actually is, because 70 to 73% of economic activity and GDP is people spending money. So if retail sales were bad during December, holiday, Christmas time, then what is the rest of 2024 going to look like? Probably not that great. And as I'm sure you know, I've made it abundantly clear, the biggest risk to Tesla or to our broader markets this year is going to be whether or not the economy holds up and the labor market holds up. If it looks like we're heading into a slow period or a recessionary-like period, stocks will sell off first, ask questions later. So you could avoid a recession like we did in 2022. Technically, right? You were in a technical recession, Q1, Q2. It was never officially declared. Still, stocks sold off and hit the lows in October, long after we were in the technical recession. That was just because of fears of a recession or a larger downturn in the economy. Now I actually think it's a lot riskier than 2022 because there's a lot less money out there in the system. Earnings expectations are high. There's a lot of uncertainty around Fed policy. Markets are pricing in a lot of rate cuts. The Fed's saying they're not going to do a lot of rate cuts. The last CPI report we just got looked not so great, at least on face value. So there's a lot of different risks that are currently going on out there. Who knows? Geopolitical tensions as well. I think 2024 is a pretty dangerous year, at least in the first half of the year. Good news is, on any weakness in the economy, well, the government is going to very much tell the Fed, you got to start cutting rates faster. You have to start accommodating the markets. We cannot have a stock market crash right before an election. That is no bueno for any president, no matter who the president is. You don't want that. 56% of United States citizens now own stocks outside of just traditional 401k measures. So people watch their portfolios. If their portfolios are falling based on the economy, people start to lose their jobs. That's bad news. So I think that does limit to some degree the downside that you're going to get. I think a 20% pullback, kind of unlikely. 10, 15%, almost guaranteed at this point, in my personal opinion. Which it is noting that a 7% pullback every year is average. So, I mean, 10%, 15%, it's not too uncommon to see that. Tomorrow, you will also get a lot of manufacturing data, capacity utilization, manufacturing production month over month, year over year, business inventories and retail inventories excluding autos month over month. Again, you just want to watch the direction. Is it saying the economy is slowing down? Are these data points saying the economy is doing okay? That's what will matter. You will also have a 20-year bond auction coming at 1 p.m. tomorrow, Eastern Standard Time. You want to see, is there good demand here? If there is, that's great. Yield should fall, and that'll be good for stocks. You will also get the Fed Beige Book coming out at 2 p.m. That's basically a report of how the Fed districts are doing, labor market, economy, inflation. That's important. I like to read it, but markets don't always react to it. And then you do have Fed Williams at 3 p.m. tomorrow as well, and he will move the markets. My expectation is retail sales month over month could come in a little bit light, maybe 0.2% month over month. Maybe a little bit lighter than that. I'm not thinking we're going to see a huge beat on retail sales, so I am more so leaning towards downside coming tomorrow off of retail sales. But is it possible we had a really strong December? Of course. But based on the numbers that we've seen for November, there was a lot of spending in November. So to get a big beat month over month from an already high number in November, probably going to be pretty difficult. Now, today we also had some very troubling data. The New York Empire State Manufacturing Index just absolutely plummeted. We talked about this in the last video, but it's actually very bad news. The New York area manufacturing is basically gone at this point. You are getting down to some of your Rona lows when basically everything was shut down. You've never been this low on this index besides the Rona, right? The 08 great financial crisis, you are higher than where we are now. You've never been negative 40 before. Some people were thinking initially that this could have been like a typo. Maybe we only really seen like negative 3.7%, but no, this is a real number. You were expecting negative 5. So this is a bad start to some of your manufacturing data for 2024. As far as Tesla stock, when I boil all of this down, I think there's a lot of risk in the near term that Tesla stock could go lower as per the video that came out Sunday night. I'm not expecting too much this week. I think we either trade between 210 or 225, 210 on the low end, 225 on the high end, but you probably end the week where we started the week around 219, 218, where we are currently at. Next week with Tesla's earnings is when things could get a lot more volatile. Let me know what you think about this information down below in the comments section, but I do think the second half of 2024 is setting up for to be a really good period of time for Tesla. And I think this is your accumulation phase. If you are bullish on Tesla, this next couple of months gives you a chance to buy more Tesla stock. If you wanted to buy Tesla at $260, $270, $300 over the past 12 months, and you did not pull the trigger then, well, now is a pretty dang good time to do so. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. Again, if you want to come join the private trading community, check out that link down below in the description of this video as well. You guys have a great rest of your day, and I will see you in the next one.